Frequency Podcast Network. Stories that matter, podcasts that resonate.
So is it going to be a $60 billion deficit? How about $70 billion? Maybe even, for good measure, $100 billion. Well, when the Carney government unveils its first budget on November 4th, the fact that we haven't had a fiscal update in so many months, combined with the seemingly daily changes to the trade file, the numerous hits to the economy, and all of the plans for big spending, well, analysts have been doing a kind of a best guess on what to expect. And those most interested in looking at the red ink might be the credit rating agencies. A report in by Desjardins Financial wonders, will Canada stay AAA? Welcome to In This Economy. My name is Mike Eppel. The author of that Desjardins report on the budget outlook is Randall Bartlett, Desjardins Deputy Chief Economist. I spoke to him this week and started by asking about how much of a risk there is that the credit rating agencies will frown at that fiscal forecast and the possibility of a downgrade.
Yeah, I think it's a great question, Mike. It's one of those things where as deficits get larger, debt gets higher, credit rating agencies are going to be turning a more critical eye to Canada and how sustainable its fiscal situation is. But I think when you're looking at credit ratings, there are a couple of things you need to keep in mind. One, and the big one really, is that credit ratings are both absolute as well as relative. So when you look at how Canada's doing in an absolute sense, our forecast is for much larger deficits, but a debt to GDP ratio which is flat or rising over the next decade. And so it's not increasing exponentially, certainly, but just grinding gradually higher as a share of GDP. And it's very much in line with the forecast that the Parliamentary Budget Officer published a couple of weeks ago. So it's not good, but it's not like what we saw in the 1990s either. And then you have to take Canada's fiscal situation into account in a relative sort of context. And Canada's deficits, even at the size that we're projecting, are going to be relatively small compared to other G7 countries outside of maybe Germany. And our starting point is good compared to most other big advanced economies, again, outside of maybe Germany, Australia, New Zealand. But when you compare us to big European countries outside of Germany, the UK, the US, Japan, Canada's starting point is pretty good for its public finances. And so it's one of those things where, yes, it's not headed in the right direction. Could things be better? We think so. But is Canada likely to have an imminent debt downgrade given its fiscal starting point and fiscal outlook? Probably not.
Well, this is the way the Trudeau government had kind of always couched things. Well, we've got the best debt to GDP ratio in the G7. And I mean, that's fine, except it always kind of, to my mind, equated to, well, the house is standing, but the kitchen's on fire, but don't worry about that. I mean, it's always this, how it's, again, compared to others. Should we really be just looking at our own fiscal situation and say, yeah, we got some potentially long-term stresses here. What about fiscal guardrails and all those kind of things that had been previously talked about?
I think it's a great question. And I think you do need to be concerned about your own house as well. I think if a government is going to be running large deficits, it is incumbent upon them to make sure that they are doing their best to get value for money all the time. And that spending is going into things that are going to lead to long-term economic growth, increase in living standards and prosperity for Canadians. And I think that's the case that the Carney government is trying to make. Ultimately, by directing these funds toward defense and infrastructure and that kind of thing, I think that they are planning on investing in more capital. But at the end of the day, the proof of the pudding is in the tasting. And we saw back in the 2015 election, which I'm reminded recently was just a decade ago, that was the focus of the Liberal Party at that time, was running small deficits to invest in infrastructure. And what we found was that when it actually came to execution on that mandate, it was much more difficult than they had expected. And it didn't lead to the kind of economic outcomes that they had hoped for, or the Canadians had hoped for. And so it isn't a slam dunk that running these big deficits is going to lead to better outcomes for Canadians. And ultimately, Canadians are going to get saddled with that debt, whether it's the outcomes are what they hope for or not. And so I think that it's a big gamble, and there are a lot of risks to the downside around this.
But you make the argument that perhaps the previously announced income tax cut and the tariff reversal, reciprocal tariffs, maybe those should have been waited on. And I don't know if the revisionist history, we've been dealing with a moving target all summer for the most part. So I give the government some leeway in that regard. But the deficit was already there. The economy was already slowing down, and to take away more revenue may not have been the best strategy when faced with all these other issues to prepare for what again you think could be an even larger deficit going forward.
Well, I think that when it comes to the revenue side of things, I think that ultimately, by reducing the tariffs on imports from the U.S., that's what helped the Bank of Canada cut interest rates by reducing the outlook for inflation. I think it's certainly going to be a positive for real GDP growth. We're expecting it to be 1 to 2 tenths of a percent higher next year as a result of getting rid of the counter tariffs on most of the imports coming from the U.S. that were tariffed before. And so there are trade-offs, but ultimately those trade-offs mean that you're going to have lower revenues in the near term in particular than you would have had otherwise. And so it's happening at a difficult time. When it comes to the tariffs, so I think it's a pretty clear trade-off in terms of, I think there are benefits to Canada, and there are some material offsets there that, kind of make it more of a wash than it might have been otherwise. When it comes to reducing personal income taxes, I mean, we all like to pay lower personal income taxes, and Canadians pay among the highest personal income taxes in the developed world. And so certainly it's something that's going to be welcomed by many Canadians. At the same time, it does add to the deficit and the debt. And so, when we look back at what we saw during the fiscal consolidation in the 1990s, tax cuts took place after deficits and the debt got under control. I'm hoping we don't find ourselves in another situation like that in the future where we are in a potential fiscal crisis that ultimately needs to require deep cuts to spending as well as higher revenues to help get that under control. So let's hope that's not the case.
Very fascinated to see how this the way that the government is structuring the budget, the operating side of the ledger and the capital spending plans, long-term spending plans. If that helps, I guess, explain a little bit more where the money's coming in, how it's going out, and this idea of what you got to pay for today and what you have to pay for over the course of time.
Yeah, I agree. I think capital budgeting is a real positive. We see it in other governments in the OECD. We see it, provinces do it too. They provide a lot of focus on capital spending in their fiscal documents. But when you look at the definition that those other governments use for capital spending, generally it is hard capital. In, say, the provinces in Canada, it's hospitals, it's schools, it's roads, it's rail. It's very, very clear what that is. They tend to issue debt that has a maturity that's in line with the useful life of those assets as well. In contrast, I would say the federal government has been very generous in the definition it has used for capital spending, in that it's roping in quite literally the kitchen sink into it by roping in tax expenditures for putting in second units in people's homes, tax expenditures for research and development, really things that I would say are generally considered to be spending through the tax code as opposed to capital investments. And so I think they're being very generous in the definition that they're using. On the flip side of this is going to show that operating expenses are much smaller than they might have been otherwise. And so it's going to make it easier for the federal government to show a balanced, quote unquote, operating budget 3 years from now, because there's so much that's going into what they're considering capital spending that is arguably a bit questionable.
Now, do you think that because we haven't had a budget in such a long time, that when we actually get the document on November 4th, that there are going to be some things maybe, unexpected, the size and scope of some of the spending plans, and just trying to wrap our heads around the fact that government expenditures are going to be way up, and it seems like every other week they're adding to the mix with support for various sectors of the economy which have been hammered by tariffs.
The $100 billion deficit number has been out in the window. Apparently, it was leaked by senior officials, and our sense is that it's going to come in somewhere between our estimate from doing all the bean counting of around $75 billion to that $100 billion range. But markets are prepared for a number in that sort of magnitude, and Canadians as well. But in that context, I think too that a lot of the measures that have been announced this fall were in the election platform, and so they're really kind of formalizing a lot of things that were announced back in the spring, and we are seeing some new measures coming in, certainly like dropping of the digital services tax, that kind of thing. Wasn't expected back in the spring, but it can have an impact on the deficit. But ultimately, a lot of this is sort of a rehash of what we saw back in the spring. And so I think a fair bit of this has already been baked in the cake by fiscal forecasters.
Having said that, though, you've still got, support for the steel industry and the aluminum sector and forest and autos, and all of these things. Are they going to be like line items in the budget that they might not grab all of the headlines, but when it adds up, I mean, that's one issue. And of course, the big percentage increase in NATO defense spending. I mean, that's going to be, when we actually see a real number on that could be really quite high.
No, absolutely. Absolutely. I would say the risks in the to our forecast are to the downside, to larger deficits and higher debt. And ultimately, if this doesn't increase productivity growth as is expected, then ultimately, our economic outlook could be weaker as well. And so the risks are very much tilted to the downside. I feel like the federal government is kind of, setting this up for perfection. And that, real life sometimes gets in the way, and that in all likelihood, things are probably going to be, worse in terms of the fiscal outlook than our current numbers are suggesting. But these are the numbers that we have available to us, given, as you said, the lack of a federal budget this year.
The other thing, too, I'll leave it at this point about this chatter that's been going on in Ottawa about the risk of a snap election if they don't get enough support. This is a minority government. They need someone along, in the opposition parties to support it, to get it into, because it's going to be a confidence document. If that were to happen, and I'm guessing the risk of that are pretty low, they'll probably have some support from the NDP. But if that were to happen, would the credit agencies take note of that and go, this is a country that can't even get a budget done, for goodness sakes? And that would that be a real red flag then?
I think if the budget couldn't get passed, I mean, it would be a money bill, which would mean the government would fall if they can't pass a budget. So we'd be off to another election at that point. I think the credit rating agencies wouldn't look favorably on this, most certainly, because it would suggest there's a lack of stability in fiscal decision making in Ottawa. Investors wouldn't look at it well either. I'd say where Canada's done really well in attracting international investor flows over the last 6 months plus has been how erratic fiscal policy and just policy generally in the U.S. has been versus the relative stability that we've seen here in Canada over the last 6 months. And I'd say the focus on investing in in infrastructure, in defense, in reducing regulations, doing all of these things that should be positive in the long term toward economic growth and living standards. And so that's attracted a lot of international capital to Canada that might not have come otherwise. And so I think there is a real risk there, but I would say that this is probably part of the game that takes place in a minority parliament where, the governing party of the day has to get other parties on side to pass the budget. And part of that process can be calling them out in public. And so I think that's probably the stage that we're at right now.
Randall Bartlett, thank you very much for joining me.
My pleasure. Thank you so much for having me.
That was Randall Bartlett, the Deputy Chief Economist at Desjardins. My name is Mike Eppel. You've been listening to In This Economy. If you want to contact us, reach out with any story ideas, my email is mike.eppel, E-P-P-E-L, at rci.rogers.com. On social media, I'm at Eppman, E-P-P-M-A-N. Again, thanks for listening.